Hello. Hello, this is strategy number 5, volume spread analysis. And make sure you read the book Master the Market before our lesson, in our lesson 1, before using our strategies. This strategy apply on gold, GBP USD, Euro USD, AUD USD, USD JPY, USD CAD, and New Zealand USD, Bitcoin, and oil, and few other instruments. You have to choose the time frame depending on the session. If you're using Asian session, you use the time frame 1 minute, 5 minute. If you're using UK session, you use the time frame 5 minute and 15 minute. If you're using US session, you use the time frame 15 minute, 30 minute, or one hourly session. Make sure your trade should be a if you take your trade on the basis of this strategy, your trade should stop loss must be 50 or below 50 pips. Any trade that exceed below above 50 pips stop loss, don't take that trade. Ideally the stop loss should be 20 to 30 pips or 40 50 pips. Never should be a 60 or 70 or 80 pips. Okay, that's very important. Now again, the broker will use ExitTrader for mobile and for ExitTrader demo account to read the volume, especially on mobile, and then the desktop as well. If you are not, if you are using TradingView, then you can use Wanda broker charts. Okay, let's come to the strategy. This is a gold chart, 1 hourly chart. Here is a low, and market start going up, slowly going up. Then suddenly a market high volume came in on the market. First high volume coming on to the sell candle. See the sell candle. Market is coming on sell candle. There is a ultra high volume, means something going on there, whether buy or sell. If this is a sell candle, then we will be sure that players are buying at this sell candle. Then market gone up, have a huge wick. Then again there was a huge ultra high volume. Maybe players bought too much, that now market started reverses upside. Then again a sell candle, there is again ultra high volume. So in 2 to 3 candles with different dynamics, buy and sell candles, market is showing ultra high volume, UHEV volume. You will place a box here. Never go against the trend, trade within the trend. So you should place a box here. Whenever market go above, ignore box. When first you have a sell candle, you have a ultra high volume, a volume which is greater than previous 10 to 15 candles. Then you have a buy candle, then you again saw the ultra high volume. Then you have again a sell candle, you saw the ultra high volume again. Then finally you got buy candle with a low volume. Now you can buy that. You can simply buy there and you can place stop loss there. This is the strategy in which you get, in the buy side you get 1 or 2 sell candles of ultra high volume, then you get a buy candle of ultra high volume, then again you get a sell candle of ultra high volume, then again you get a buy candle with low volume. Then you, whenever you see a low volume on buy candle, just buy it, place stop loss below, and expect 1:3, 1:4, 1:5, because this all activity, player is active, and player is active. And when market is going up, now market maker watch the situation, that what's the situation. Market maker actually removing their sell liquidity. When their market makers are removing their sell liquidity, means player actually, what they did, they actually bought more than sold. They bought more positions than actually sold. So on this way, due to their more buying than selling, the market is slowly drifting up, and the marketers was watching this situation. They reacted to the situation and they removed their buy liquidity. That is why market is going up with low volume, means there are no resistance to the upside, because the liquidity of sell orders were removed from the market. So market will start going up. So you have to buy on this bullish candle, and you should place stop loss below this bullish candle, and just expect 1:4, 1:5, 1:6. That's a tricky strategy, but that's a very powerful strategy. But it's not, this setup never comes on low, exact low or exact top. It comes when there is a established low behind that, or established top behind that. Again there is top established behind that there is a downtrend starting, then there is a two sell candles with ultra high volume, then again market goes up, then market there is a buy and there is a low volume on buy candle, then market have a sell candle and on sell candle there is a low volume. See, there is a low volume, so you can sell there, you can place stop loss on above, and you can expect 1:4, 1:5 in this strategy. Again, there is a low established, market is going up and market is going on these two buy candles, there is a ultra high volume. On these two sell candles there is also ultra high volume, a volume which is bigger than previous 10 to 15 or 20 candles or volumes. Look, this is a M30 chart of gold, and the ultra high volume on all these candles, especially these two buy candle and these two sell candles. These two buy candles have a ultra high volume, and then these two sell candles with low spread also have a ultra high volume. Wait for the market. If market gives you a buy candle with low volume, just buy it. Place stop loss below and expect 1:3, 1:, you got the 1:2, 1:3, then market drop back. So that's a very powerful strategy. Again, there is a low established, this is a gold chart, M30 chart, there is a low established, market is trending toward upside, suddenly market is going up with the ultra high volume. Okay, but market gone down with also an ultra high volume. So you don't have strategy for that. I told you in our first strategy that if you have a ultra high volume on up candle, then if market reverse back with low volume, then you need to sell. But in this case, market is dropped with high volume, so that means you should be doubtful. Then wait for market to go up. If market is going up exactly after this ultra high volume sell candle, then buy that, stop loss is placed below, and expect 1:2, 1:3. Okay, that's very important. Okay, again I am repeating that market is going up with the ultra high volume, then market dropped with also an ultra high volume, and next candle jump up with low volume. That means that you need to buy here, and you to place stop loss below, and you to expect 1:3, 1:4, 1:5. Okay, again there was a low established below, market was going up, there was a ultra high volume there, then market have a ultra high volume on this thing, then market have a buy candles with ultra high volume. You box it out, you put a box on this ultra high volume points, then you wait for the breakout of, then you got the engulfing pattern, low volume engulfing pattern. Means low volume engulfing pattern means this buy candle have low volume. When you see engulfing pattern after low volume engulfing pattern after this activity of ultra high volume candles, you just buy it, place stop loss below, and expect to 1:2, 1:3 accuracy trade. Okay, that's very important. So look at the volume, low volume on engulfing pattern. So that was your go-to entry, that was your stop loss, and that will trade give you a 1:3 profit. Again again there is a market have a top in front of it, and market is going down, then you have a two sell candle with a ultra high volume, then suddenly you got buy candle also have ultra high volume, then you got sell candle with low volume. Just wait for this break, or even sell it this low volume sell candle breaking the box, and place stop loss above, and you get the 1:3, 1:1, 1:4 activity. Simply the situation is that when market was dropping, there was a ultra high volume on this candle, on this sell candle. You have idea that something is going on. There are players who are buying in the market, because on red candle always smart money buy. Then next candle also a sell candle with ultra high volume. You got the point that market is the players are actually buying it there. But when buy candle came in, then another ultra high volume is showing that the players are actually now selling in the market. Previously they were buying, now they are selling. And In this case, next candle reverses back, confirming that low volume sell candle means now market is ready to go downside. The market maker saw the situation, what's going on behind that. There is more selling than buying. I mean, there is buying as well, there is selling as well, but this engulfing or this sell candle with low volume is telling us that there is more selling than buying, and there is no pressure to the downside. But the market maker actually removed the sell liquidity. Now market has to go down. Okay, or you will get a trade of sell here, place stop loss above, and you get 1:3, 1:4, 1:5 trade risk reward. Again, the top is the bottom is already in place, market is going up, suddenly you got buy candle with the ultra high volume, then a sell candle with the ultra high volume, and then two buy candle with the ultra high volume. Then you got a engulfing pattern here with a low volume engulfing pattern. You just buy there, place stop loss below, and expect 1:3, 1:4, 1:5 accuracy, 1:5 risk to reward ratio trade. So that's very simple strategy. If you have confusion, you can email me as well, and when you email me, write your WhatsApp number there as well. I will personally help you out. Okay, and this in this setup, you should, in buy side, you should have ultra high volume on buy and sell both candles. Okay, again, this is a chart of oil, crude oil, 30-minute chart. There is a three sell candles with the ultra high volume, then there is a buy candle with ultra high volume, then again there is a sell candle with ultra high volume, means that the whole candles, all candles are all getting ultra high volume. Wait for one buy candle within the that is within the trend and with low volume, that is the buy candle coming within the trend with low volume, just buy there, place stop loss below this box activity, and get the profit of 1:3, 1:5, 1:6. So that is the strategy. Again, there is a top already in place, market is coming down, then on down market is getting a ultra high volume, then market have a jump was also an ultra high volume. Now wait for market to wait for next candle. If next candle with low volume coming down, breaking this low of box, then sell this and place stop loss above, and then get risk reward 1:3, 1:4, whatever you got. Okay, so that was also a very simple case. And this is Euro USD 1 hourly chart, Wanda. You see a ultra high volume on buy candles, then you see a ultra high volume on sell candles, and then you saw engulfing pattern, low volume engulfing pattern, just buy there, place stop loss below that, and just get 1:2, 1:3, 1:4 you got on this trade as well. Okay, this is a very powerful strategy. Again, Euro USD chart, M30 chart, market is going down, market have three sell candles with the ultra high volume, but market is also have a ultra high volume on buy candle as well. Ultra high volume on late side in box. If you box all the scenario, ultra high volume on late side will have more power. So here the late side is bullish, ultra high volume on bullish is actually sign of weakness. Now market has dropping back, down slowly with low volume. So when market go below this box, or even start of this move, market was volume was low, you can sell it, you can place stop loss above, and you can have 1:3, 1:2 accuracy risk reward. Now this is a British pound chart, M30 chart. You have a UHV box, you have a high volume on these all candles. Then on buy candle you also have ultra high volume, then market start consolidating, and then slowly dropping. You can sell off immediately when you are getting that market is coming down with low volumes. Okay, after, especially after this buy ultra high volume buy candle. So this buy candle, so this is a sign of weakness. You can sell there, you can place stop loss above there, and you can get 1:2, 1:3 there. This is a British pound chart, 15-minute chart. Again market is going up. There is a ultra high volume on 3 buy candles, then same there is ultra high volume on sell candle as well. Then you saw buy candle with low volume, then you saw engulfing pattern. This engulfing pattern when came in, you just buy there, place stop loss below, or you can expect 1:3, 1:4, 1:4 on this risk reward. Okay, so engulfing pattern, either low volume jump or low volume drop will be your go-to point entry. Okay, so this trade never comes to the top or bottom. This scenario comes when there is already bottom or top in place. Again, USD CAD chart, 1 hourly chart, bottom is already placed, market was going up. Suddenly there was a ultra high volume on sell candle, then market jumped, there was ultra high volume on buy candle, then market dropped back, there was ultra high volume on sell candle, then market jumped, there was small volume on buy candle. Now you can buy there on this engulfing pattern. Okay, you can buy there, you can place stop loss there, and you can expect 1:3, 1:4 from this trade. Again, this is a USD CAD 30-minute chart. Markets were going down. Market was going down. There are 2 candles, sell candle. These were with ultra high volume. Then wait for then there was a buy candle, same also have ultra high volume. Then wait for market to reverse. If market reversing with low volume, then simply sell this, place stop loss above there, and you get the 1:3, 1:4 accordingly. So that is a very tricky type of scenario, but that trade within the trend. Okay, again this is a USD JPY chart, 1 hourly chart. There was a drop and ultra high volume on all sell candles. Then you got the ultra high volume on a buy candle as well. Then you wait for next candle drop back with low volume. You just sell there, place stop loss above, and you get the 1:2, 1:3 easily. So that was a simple scenario. Look, these are the sell candles. On sell candles, what professional big players do, they buy. But when they buy and when market jumps back upside, still there is huge selling involved in the market. Like volume is high, volume should be low, but volume is high. That means that market is not ready to go up. So the big players, they were actually buying, now started to unload their holdings, and now this was more like a selling than buying. Maybe this was more like a selling than buying. Big players were more selling than buying. Okay, at some situation big players do selling and buying both collectively. Okay, some players are selling, some players are buying, so both are fighting. So whoever will win will dominate the market. So one player was selling, one player was buying, and the player who was buying got little jump as well, but the big players who were selling were dominated the market, and the low volume drop is actually confirming that case. And the market maker who were watching this fight saw that market is now ready to go down. They removed their buy liquidity and market dropped down. That is the actual logic behind that. Same is the case, market dropped down. Maybe there was aggressive selling from big players, and then market start going up. Still big players are actually selling in this case, and that is why on this jump market have getting high volumes. Then market start ranging and going down with low volume, you just sell it. Same case on all. There was a aggressive sell candle, players were buying. Then market got huge buy candle, but still there was ultra high volume. Wait for the market, then market start dropping. Then again there was ultra high volume, then market start jump. There was a low volume. You not have to take the trade here. You should place stop loss below, and you should expect market to go up. And similarly, market makers saw the situation that they are buying and selling of smart money collectively as average resulted the upside. So the market maker reacted accordingly, and they removed their buy liquidity, and market is going up. So that was the logic behind that. So this setup is also formed time after time in front of you, and you have to act accordingly. And Again, market players were actually aggressively buying there. Then there was a sell candle came in, then market maker continued to buy, and this engulfing pattern was evident to show that market is ready to go up. So market ready to go up, then markets got few range as well, and you can highlight this range and then breakout, you can take another buy entry as well. Okay, so that is very simple. So again, in this case, market is going down. Maybe this was not aggressive buying from players but aggressive selling. Then market attempted to go up, then still there was ultra high volume, which suggests that players always sell and buy candles. Then market start going down with low volume, means now market maker is confirming that the market is not ready to go up, market is very weak, and they are removing their buy liquidity. Okay, so market is now coming down and you have to sell there, you have to place stop loss there. That's very tricky type of setup. Before, all setups were like go against the candle size, but this is the only setup in which we are saying that market is aggressively selling. Players are not buying, but they are actually selling in these drops. Okay, so you can watch all these setups. These I have same logic, and you can apply this on the market and get extraordinary profit. Just you have to highlight this ultra high volume and the box, and then if box is within the trend, and if you get a low volume jump after this ultra high volume activity, just buy there. If you get a bullish engulfing pattern, low volume bullish engulfing pattern, that's a very good entry as well. If you have any issue regarding this setup, you can email me, and I can help you out on this as well. All setups are very clear. Thank you. Thank you very much.